This is like
FSA, Terry Maxwell, he just bought a site and
second story.
he's moving like every old man. He bought a property division. No, he's building. He's going to build 2 25-story towers.
And this has never
No, he wouldn't sue the city. Just shirking away. Might be worth again after 432 March and one.
Yeah,
before they cool off. Things aren't great for those. It's hard to take a network. Is that controversial?
Okay, folks, before I start, there's a question I've been getting for the last 3 or 4 days that I'm sure is going to become real for most of you over the next week or two. But for many of you, when you did your valuation, you sent it in to me, you used the 2021 fiscal year as your most recent year, right? And you know what's been happening in the last few days? We've got first quarter numbers coming out. And the question I'm getting asked is, do I need to update my DCF? This is a tough question to answer because your recommendation is going to be as of May 9th of 2022. You're going to tell me whether to buy or sell the stock. Now, you know the answer to the question already. If you want me to have a recommendation that I can act on, you want your numbers to be as updated as they can get. But before you freak out, you're saying, this means I've got to go back to scratch. I mean, all that means is you take the first column of numbers you have and copy it in the second column. Basically, your most recent year will become the last 10K. You'll have trailing 12-month numbers. It'll take all of 15 minutes to do. But if you don't have that 15 minutes, you could probably get away not doing it if your story is not changed by what happened in the first quarter. Remember, ultimately what drives your valuation is not your base year, it's what you have as end revenues and what you have as margins. So the first quarter numbers are kind of, they basically reflect your story. You could probably get away without doing it, but if you're really going to act on your valuation, it might be good to actually update. But if you have Netflix as your company, for God's sakes, don't even ask me this question, do I need to update my numbers? Because you know what happened after close of trading yesterday, right? The company announced that it lost 2 million subscribers, and it's probably underestimating, to be quite honest, because they're acting like something bigger is happening underneath. You know what else Netflix announced yesterday? I never thought this. They announced that they might start introducing a cheaper version of Netflix if you're willing to watch ads along the way. Netflix, Reed Hastings historically said he doesn't want to be in the ad business, but this is desperation time. Okay? So will your value be different if you update the numbers? Just probably because your story is going to have to get a little more pessimistic. I would be surprised if your value dropped 10% or 15%. You're saying that's terrible. You know what the market did today to Netflix? Down 35%, at least when I last checked. So your assessment of Netflix a week ago is they're overvalued, I'm not interested. Today, all of a sudden, you could get interested because it's the right price. So I think that it makes sense to update the numbers. But as I said, if you feel nothing much has happened in that first quarter, it's too much work, you really don't want to spend that 15, 20 extra minutes. Leave it at 2021 numbers. Your valuation is probably going to be the same. Update at least the price. That you have no choice. because there's no point telling me the price on March 31st was. What the heck am I going to do? Put myself in a time machine and go back there and buy the stock? It's always going to have to be today's price. So today we're going to talk about IPOs. So I'll describe how an IPO process works. You're a banker. I'm a company that wants to go public. This is the traditional process. It's being challenged now, but it's a traditional process. I come to you and say, look, I want to go public. And I ask you to set an offering price, a price per share at which I can offer the shares on the. So you go out and you do your homework. Why? Because you're a true believer in intrinsic valuation. You put numbers into a discounted cash flow model, you come up with the value per share of $10 per share. And then you do a pricing of the same company. You use multiples, comparables, whatever you use as a comparables, and you come up with $20 per share. So here's my first question. If you're the banker and I want you to give me a number for the offering price, would you give me the $10 per share, or I'm sorry, 20 or the $25 per share pricing? Which is the number that would be my operable number? Yes.
The pricing,
And why?
because that's the prevailing market price. Perhaps there's a value when someone is willing to buy that at that price.
In other words, your mission is to facilitate the transaction, right? I mean, I'll give you the analogy. Let's say you have a house to sell. You hire me as a realtor. I've built this great intrinsic value model for houses. I've got all these equations. I come up with an intrinsic value of 500,000. But everybody in your neighborhood is selling the houses for 2 million. How long would you keep me as a realtor? You're going to fire me on the spot saying, I don't care what you think. I can get 2 million for the house. IPOs are pricing games. Which raises an interesting question. Why the heck would you ever even show me a discounted cash flow valuation as a banker in an IPO? What's this kabuki dance you're doing? It's a pricing, just make it a clean pricing. But let me carry that to the next step. You come up with the pricing of $25. And then, this has been the traditional part of the process, you guarantee me a price because bankers write this underwriting guarantee. So let's get rid of the $10 option. It's out of the table. $25 is your pricing. Let's say you feel pretty comfortable with the pricing. If you're going to set a price for this that you're going to guarantee, would you set a price lower than 25 or higher than 25? You're going to set it lower because you got to deliver on that price, right? You can see that this process is built in to create a discount on the actual price because you got to protect yourself. And that raises an interesting follow-up question. If the pricing is 25 and I discount it and give you 20, that's $5 of your money that I'm losing for you, right? So if you're the company going public, if you were selling all your shares on the offering day and I discount the price by 25%, would you accept that? I mean, that's a lot of money to leave on the table. But in most IPOs, you don't offer 100% of the shares in the offering day. You might offer 8 or 10 or 12%. Let's say you're the owner of the company and you're fully aware that I'm underpricing your offering. Might you be okay with my underpricing? And if so, why? Why?
It's less risky for you to just
Well, you're going to get the guaranteed price. So there's no risk at all. So, if it's risk, the guaranteed price, you prefer to get the higher guaranteed price. Because if you don't hit that price, the investment bank has to come up with the difference. So why might you accept the underpricing, even though it's your money you're leaving on the table? What's the news story you're going to see in the Wall Street Journal next day about your company? On the opening day, the stock price jumped 35%, right? You're saying, so what? Other people read the story, right? And they get a serious case of FOMO. My God, I missed out on that offering. And they don't stop there. What do they do then? They buy the shares in the days. What you're hoping is the momentum from the story will continue pushing the price upwards until when? Remember, in most IPOs, the owners are not allowed to cash out for a period after the IPO. There's a period where you're forced to hold the shares. You're hoping that this carries over 6 months, a year, and that when you get ready to sell your shares, they'll be at a higher price. It might be all hope and hype. It might never happen. But we're going to talk about the IPO pricing process, why there's the discount, how it shows up. when you look at the actual data, and whether you and I as outside investors might be able to take advantage of that mispricing. So lots of things on the agenda. Let's go back to packet 2. I think we were on, lots of packets opening here. Okay. Let me take you back to where I left you with private company valuation. Remember we talked about illiquidity? We talked about the two ways in which appraisers get a discount. They look at restricted stock studies where companies issue shares at a discount on the actual price, or IPOs. And I talked about the sampling problem. What's the sampling problem? Only companies in trouble go out and issue restricted shares. So when you get a discount from that, it's dangerous to extrapolate to the rest of the sample. Same thing with IPOs. Not all companies that plan to go public actually go public. So if you just focus on companies that actually did go public and work backwards, you have a sampling problem. And there's no easy way out of those problems with these samples. So I'd like a different way of thinking about illiquidity where I can look at where did the page go? Okay. Can you guys see the slides that I'm clicking through very fast or not at all?
No.
Okay, let me. How about now? No? Now you can see it?
No.
Okay. So let's talk about a different way you can think about illiquidity. What if I could give you a much bigger sample of stocks without the bias? Okay. I don't know whether you remember, but in the last class, I talked about the fact that when you buy a publicly traded stock, the liquidity discount is the cost of buyer's remorse, which is you buy Twitter and then you sell it 1 minute later, assuming the price hasn't moved. What's the cost to you? Well, you have, of course, the $5 or $3 that you pay per trade, but you also have the bid-ask spread. Right? If you buy at 50, you sell at 49.50, that's a 50-cent bid-ask spread. I can observe that for all publicly traded stocks. I remember 20 years ago when I started, this is one of the most tedious exercises I went through. I collected the bid-ask spread for every publicly traded stock. There's a database. I had to merge it with another database, and I ended up with bid-ask spreads as a percentage of the stock price for every publicly traded US company. So you look at very liquid stocks, that spread was like 0.1% of the stock price. And there are some NASDAQ companies which trade at $2 where the bid-ask spread is 50 cents, which means that you're effectively giving up 25%. I got that bid-ask spread for every company. And then I collected data on these companies. How big were they? Were they making money? In other words, I was replicating what people did with the restricted stock studies with all US stocks. I ended up building a regression equation of the bid-ask spread as a percent of the price against the revenues that this company has. Again, big companies should have smaller spreads than large companies. Whether they were making money or not, how much cash they had on their balance sheet. Cash is, of course, the most liquid of assets. And finally, what the trading volume was. The regression had an R-squared of only like 30%, but you're trying to explain spreads across lots of companies. I'm not surprised. Every one of these coefficients was statistically significant. You think, what are you going to do with this? Remember that restaurant we valued last session? If I wanted to attach a liquidity discount, here are 3 ways I can come up with that discount. If I do what appraisers do, which is apply the bludgeon, every company gets knocked off by 25%, I'm going to take the 521,000. I estimated the value of equity in this restaurant at and knock off 25%. That's the first choice. The second is, if you remember, I took the restricted stock discount and adjusted for the fact that you have smaller revenues, you might be making money. That gives me 28.75%. So that came from the silver regression of restricted stocks. But there's a third way I can come up with an illiquidity discount. I took the regression on the previous page, plugged in the revenues of the restaurant. I know it's not a publicly traded company, hang in there. I took the revenues, I took the fact that it was a money-making company, it had 5% cash as a percent of value, and plugged in the fact that they never traded, trading volume of 0. I got a predicted bid-ask spread for this company of 12.88% of that. You're saying, what does that even mean? It's not a publicly traded company. Remember, the spread is an assessment of the illiquidity discount in a publicly traded company. I'm saying if I treated this restaurant like a publicly traded company, what I'd expect to see as an illiquidity discount is roughly 12.88%. I can now adjust the discount for different private companies by plugging in the numbers, but that 12.88% discount gives me a value of equity of 454,000. So let's review the 6 steps. We came up with the cash flows. We adjusted the discount rate for the fact that the buyer was not diversified, gave us a much higher discount rate. We valued the business, adjusted for the key person discount, and then we reduced that value. Lots of cutting in value as we go along, right? At each stage, I'm shaving off value. By the end of the process, I've got a value of only 454,000. Now, I would be surprised if you're the owner of the restaurant, you're disappointed. So let me give you a second valuation of your company. Here, instead of valuing your company for sale to another private individual, which is what I've done so far, I said, what if you were selling your restaurant to a publicly traded restaurant chain? They might want your restaurant to add to their stable of restaurants. Let's think of what's different. When a publicly traded company buys your company, there is no diversification adjustment I need to make because the investors in the publicly traded company can be diversified. So the first thing that I'm going to do is I'm going to take the the total beta and go back to a market beta. Second, once you become part of a publicly traded company, liquidity is no longer an issue. Why? Because investors in the company can sell their shares. They don't have to sell the restaurant to make their cash back. The illiquidity discount should disappear. This is like magic. So here's how it plays out. There's my private company cost of capital that I estimated on Monday for a private buyer. If I replace the total beta with the market beta, I end up with a much lower cost of capital, 8.76%. So lower discount rate, same cash flows, that's going to push up value. Even on top of that, I remove the illiquidity discount, saying, look, it's a public company. The value that I get for the same company to do two different buyers, 454,000 to a private buyer is now 1,483,000 or 1.483 million if I sell to a public buyer. If you're the owner of a private business, I've tripled your value because I've found a better buyer. But let me ask you a question. If you are the owner of the business, you sit across the bargaining table, I'm the public buyer, you ask me for 1.48 million. You know what my counter to you is going to be? I say, look, I'll pay you 454,000. Why? Because I'm the public company. Why should I pay you 1.48 million? And if I'm the only buyer in town, guess where you're going to end up as the as a person selling the business? You're probably going to end up closer to 454,000 because I, as the buyer, I'm going to say, look, I'm not going to give you this extra amount because without me, you have to sell to another private buyer. I might give you a little bit of a premium over the 454,000. I get to capture that difference. You know, we're later in a couple of sessions, we're going to talk about acquisitions. And I don't think much of acquisitions. I think value is destroyed all the time through the M&A process, with one exception. When your public companies take over private businesses, you have a chance to create value. Have you heard of roll-ups? You know what a roll-up is? What you do is Blockbuster was, for instance, go back 30 years, was a roll-up. What Blockbuster did was it went across the country to cities and towns, buying local rental stores with a big clientele. Then it put the Blockbuster name, it kind of standardized them, but they rolled up hundreds of video rentals into one public company. So think of how this works. You're a private owner of a private video rental business. I come to you as Blockbuster, and I offer you a premium on what you think you could get if you sold to another private buyer. So you think you're winning, right? I offer you 10% more than what you can make from a private buyer. But it's about 70% less than what this is worth to me because I'm a public buyer. And I do this on business after business. I've effectively captured that differential value. So the pessimistic view is I can come up with the 1.48 million, but I cannot cash out unless I get a second public buyer involved. If I can get two public buyers involved, of course, they'll bid against each other and perhaps push the value towards the 1.48 million. So here's my advice to you. If you're ever asked to value private business, maybe your father owns a private business, a relative owns a private business, do two valuations. One with the total beta for a private buyer, one, and put that in your left pocket. And then value the same business to a public buyer, put that in your right pocket. Remember which number went into which pocket, because this could be critical. And then when you get to the bargaining table, pull out the number from your right pocket, say this business is worth 1.48 million, fully expecting the pushback, which is, oh no, it's worth 454,000. You're trying to negotiate your way towards the 1.48 million, but without bargaining power, you're not going to get really close to it. So private to private, things are really messy. Private to public, it's just like a public company. You don't have to have illiquidity discounts. You can use market betas, which brings me to a third set. A private company that plans to do an initial public offering. Now, of course, there are issues here, right? Corporate governance issues, regulatory issues. But at first sight, valuing a private company for an IPO looks very much like valuing a public company. So we're going to do a trip down memory lane to October 5th, 2013. It was 2 days after Twitter filed its prospectus for its IPO. So I looked at Twitter, and here's what I saw. A company with lots of users that hadn't figured out how to monetize them yet. It's amazing how the story has remained unchanged for 9 years. So I gave my best estimate of the value of the company. So I'm going to take you through a discounted cash flow valuation of Twitter. A banker shouldn't be doing this. That's not their job. But as an investor, I care, because if I'm going to buy Twitter, I want to see whether the price is less than the value. So I built in the expectation that over time, they'd find a way to monetize the users with the revenue growth. So if you look at the revenues, it increases from, I think, 448 million was the trailing 12-month out to 11.1 billion by the time you get to 2023. I'll actually show you what the actual numbers look like now, so you can compare them to my original projections. So I'm telling an upbeat story of small revenues becoming big revenues. They're going to find a way to get profitable. Their operating margin over time is going to increase to 25%. That's not quite Facebook level margins. Facebook has 45 to 50% margins, but here's the difference. Facebook is a dominant online advertiser. Twitter, even if it's successful, will always be a secondary online advertiser. What I mean by that is if you're a company that wants to advertise, you can make Facebook your only advertising source because it reaches enough people. It's a big enough platform. But it's very unlikely that any business will advertise just on Twitter. You might reach some people, but not enough people. The platform is too restrictive. So that built into my story. I did give them revenues reflecting a secondary advertising success, and I gave them the margins that reflected that. The bottom line is, if you look at the numbers here, this is from the FCF of Ginzu spreadsheet, same revenue growth, margin, sales to capital that you've used for your DCF. The value that I get for the equity is about, for the operating assets is $9.6 billion. So far, exactly what I'd done with the public company, right? Then I added cash. I added cash and I subtracted our debt, just like a public company. But there's one more stop I had to make in this IPO. When you make an offering as a company, you make an initial offering. On the offering day, you get cash coming into the company. Why? When people buy the shares, cash comes into the company. I need to know what you plan to do with the cash before I complete your valuation. Let me explain. When a company makes an offering and raises cash, there are 3 things that the company can do with the cash. Anybody can tell me what those 3 choices are that a company faces? What are the 3 things that a company can do with the cash it raises from an initial public offering? Well, you don't reinvest right away, but you can set the cash aside to reinvest in the future. Remember, you have all these negative cash flows. So the first is you hold it in the company to cover future reinvestment. That's the first. What else can it do? It can pay down debt, or if it has done something in the past that's not quite optimal, it can use it to pay down debt or pay off financing that has very bad terms. There's a third thing that can happen.
Cover operating losses?
Operating losses are not cash outflows, right? So basically, there's nothing to cover. You can make your book value look better, but that's kind of irrelevant.
Make an acquisition.
Well, that's part of investment. So you set the cash aside for. No,
You can pay back investors.
Or owners can cash out, right? There's no effective paybacks. You can let owners sell their shares, which is what Spotify did. Spotify raised $0 in their initial public offering because every dollar that came into Spotify left the company to existing owners. Sony, for instance, which had been a part owner of Spotify, cashed out at the IPO. So the money can be left in the company, the money can be used to pay down debt, or the money can be used to cash out existing owners. What you do with the cash has to be built into your valuation. I'm going to show you the data on Twitter, but Twitter chose to keep the proceeds, which was expected to be $1 billion in the company. So why does that matter? The day after the IPO, think of what's going to happen to the cash balance of Twitter. It's going to go up by $1 billion. You see that billion added on? That's my existing cash balance plus the proceeds, because the proceeds are going to stay in the company. Later, I'll talk about what to do if you're using to pay down debt or cash out owners. But in this case, the cash is being left in the company. So that's the first real change, right? Between a traditional DCF is what you do with the IPO proceeds. I got a value for the equity, and then I subtracted out options for the same reason I subtract out options for any publicly traded company. The problem here is, remember, I don't have a market price yet to value the options. We'll talk about the mechanics of how you value options when a stock isn't publicly traded yet. And finally, divide by the number of shares. And with young companies going public, this can be a nightmare to estimate. And here's why. If you're a young company that's gone through a series of venture capital rounds, with each round, you often issue a new class of security, usually convertible preferred. In fact, you can count how many VC rounds a young company has gone through by counting the number of convertible preferred offerings they have in the books. Those all will get converted to common shares. In addition, young companies often can't afford to pay cash to their employees, right? So in addition to issuing options, what else do? They have restricted stock issues, cleaning up for all of that to figure out exactly how many shares are outstanding becomes part of this process of estimating value per share. But based on my judgments and my story, the value per share I attached to Twitter at the time on October 5th, and this was about 3 weeks before the bankers actually put up pricing on it, was $17.36. False precision, around $17. 3 weeks later, the bankers came out with their first offering price. Bankers actually get multiple shots before they get the offering price right. The first offering price they said was $20, and that freaked me out. You know why? It was too close to my value. I said, if the bankers are agreeing with me, it must be because I've done something wrong. I seriously went back and said, I must be missing something. Luckily for me, though, 3 days later, the bankers came back and pushed the price up from $20 to $26. And already you can see, you can cast as a lie when bankers talk about valuing IPOs, that this has nothing to do with value. What do you think happened in those 3 days that led them to reassess the price? You put out a price of $20. In fact, the way I think about pricing an IPO is think of the old days, bankers getting on phones. They might not get on phones now. You get on the phone, you call a portfolio manager and say, look, we're thinking about pricing Twitter at $20. The portfolio manager, that's great, that's great. You hang up the phone. The guy sounded too excited. So what do? So that's too low. Let's try 22. You call again, still too excited. Let's try it again. Doesn't sound sophisticated, but that's what IPO pricing is. So on November 2nd or 3rd, I think very close to the actual offering date, they set the price at $26 per share. November 7th of 2013, Twitter goes public. Actually, I was on, I think, Bloomberg TV, I think. They asked me to come in for the opening because they wanted to humiliate me by saying, look at the price, look at your value, how wrong were you? Frankly, it doesn't bother me in the least, but I went in anyway. So markets open at 9:30 and Twitter doesn't open up. 10 o'clock, still no opening price. You know what happened? On the opening day, there was what they called an imbalance between demand and supply. It took them 2 hours to resolve it. Too many people wanted to buy the stock. So it opened at 11:30 at $45 per share. The momentum carried through. By December 6th of 2013, Twitter was trading at $73.31 per share. I mean, think of how much money you could have made. If you got the stock at the offering price, you'd have got it at $26. You'd have tripled your money pretty much over the next 6 weeks. That was a high watermark for Twitter. December 26th. If the story had ended there, this would have been one of the great success stories of all time. Jack Dorsey would be, whichever place you put, legendary founders. But unfortunately for Twitter, the story continued. And the rest of the story is not so much fun. That 73.31 did not get revisited till 8 years later. The stock went down as low as $18 or $20, terrible times along the way. Why? Because their business model just did not click. They still had users, but they couldn't quite figure out how to convert those users into revenues and operating income. Last year, the revenues were 5.6 billion, well below my expectation. Their operating margins were 5%, well below. So basically, they were undershot on every single count. That's why they've gone through 5 CEOs in the last, I think just between 2006, their founding, and today, they've gone through 5 different CEOs. But as I said, in intrinsic valuation, you can value IPOs. Just be aware of the fact that what happens in the market is entirely set by demand and supply. It's a pricing game, and the pricing and the value can be very different for these companies. So let's take the issues that I ran into in the Twitter valuation that make it a little different from valuing a traditional public company. First, as I said, you have to deal with what happens from with the proceeds from the offering. There are 3 choices. You can keep the cash, you can use the cash to pay down debt, or you can let owners cash out. You have to treat the 3 very differently, and I'll talk about the differences. Second, there's all these loose ends you got to tie up, warrants, convertible preferred. You can't leave entire security issues to the side. They have to be brought into your value per share. Usually IPOs are pretty good about telling you what will happen with that convertible preferred stock. But you often have to make explicit assumptions about things like restricted stock. On the pricing issue, remember, bankers have guaranteed a price. They've not guaranteed a value. So it's a pricing game. So you got to think about how they price things. And the fact that they've guaranteed a price will mean that there's a discount on the price, how much the discount is going to be. So let's take those issues one by one. Let's start with the proceeds. You make an offering, you raise cash. As I said, 3 things you can do. You can keep the cash, in which case you should be adding it to the cash balance you have as a company, which is what I did for Twitter. You can let owners cash out. And this is the nicest option for you because you can completely ignore it because nothing is happening in the company. Or you can use the cash to pay down debt, in which case, what will change in your valuation? Your cash balance will not go up, but your debt ratio will go down, and maybe it'll change your cost of capital, your discount rate changes, and maybe it'll also reduce your failure risk. Remember, that's a big deal with companies. It's a young company because you paid down your debt. It might make you a safer company less likely to fail. So when you're valuing an IPO, always check to see what's going to happen to the proceeds. It'll be in the news story somewhere. You might have to do a little digging. But the news stories will tell you how much the company hopes to raise and what it plans to do. And if you get the prospectus, somewhere in the prospectus, they have to tell you what they plan to do with the proceeds. It's required by the SEC. In the case of Twitter, here's what I found. So to figure out how much they would raise in the offering, remember this was very early in the process, 4 weeks before the offering price is set. I was going on rumors. The rumor was that they were planning to raise about $1 billion. They actually ended up raising like 1.1 billion instead of 1 billion, but the initial plan was about $1 billion. And in the filing, the company specifically said they plan to keep the cash to cover future investments. So that's what's going into the cash balance. And finally, if I asked you what would be different in my valuation, so remember the valuation I got of $17.34? If instead of keeping the cash, they let owners cash out, what's going to happen to my valuation? First, let's do the direct effect. If they let the cash leave the company, what's the first number that's going to change my valuation? The proceeds of $1 billion are gone, so my value of equity is going to be lower. But that's just the surface effect, right? We said by keeping the cash, the company gets safer. It now has the cash to cover its reinvestment needs. If I'm doing a full-fledged discounted cash flow valuation, if you tell me you're going to take the cash out, I might have to revisit that valuation and give you a higher chance of failure. Why? Because you have these negative cash flows, and you now don't have the cash to cover those negative cash flows. So when companies take cash out of the business, it's almost always going to be true that the value per share for the company is going to be lower. In some cases, a lot lower than it is if it's left in the company. Any questions on the proceeds and how to deal with it? Let's talk about getting to that per share number. As I said, with young companies, the problem is you've raised capital from multiple venture capitalists before you get to the point of going public. Each venture capitalist takes their pound of flesh, taking the form of convertible preferred on top of convertible preferred. Many of them take warrants and options. So by the time you get to the public offering, you have a bunch of different securities outstanding with different rights, and you have these options to deal with. You have no choice but to deal with them. You can't just say, I don't know much about them, I'm just going to ignore them. And in the case of Twitter, here's what it looked like. The owners of the company owned the common stock of the company. And to give Twitter credit, and this made my life easier, they were one of the few social media companies that didn't create two classes of shares. Facebook, remember, that would add another layer here. I didn't have to worry about this. They did have 7 classes of convertible preferred stock. Why? Because they'd probably gone through 7 VC rounds, and each VC had put in a different convertible preferred. They had 86 million restricted stock units. Why? Because they have to pay employees, and if you don't have cash, you're going to pay with restricted stock units. And some of these employees also had options, 44.16 million. This is not penny change. Each of these is going to add to your share count. What I did for my share count is I counted everything but the options. So all the restricted stock, all the convertible preferred, they gave me the exchange ratio. My total share count reflected all those shares. Why didn't I count options? Because I valued options separately and subtracted them from the value of equity, because that I can do more directly. It's a lot of cleaning up to do with young companies. My suggestion is next time there is a prospectus for an IPO, at least read through it, because it'll give you some sense of the challenges you face in just getting a share count. To me, getting the share count is often the most difficult part of valuing an IPO. Strange thing to say. I have an easier time with estimating revenue growth and margins and estimating how many shares Peloton had outstanding on the day of their IPO. It's really messy. Eventually it'll clean up, but that's going to be 2 or 3 weeks after the public offering, and you're doing this before that offering. And finally, let's talk about the investment banks. As I said, the investment banks are here supposedly to provide multiple services. I'll let you think in your mind about all the services investment banks offer. But one of the things they offer as a service is this guaranteed price. So how much is that guaranteed price worth? It's worth only as much as what the price is set at, right? So if your realtor guarantees that they can sell your house in the next week, but forgets to mention a price, you know what the guarantee is worth? Absolutely nothing. Your realtor could sell the house to the homeless person down the street for $10 and say, look, I sold your house. I guaranteed a price and guaranteed what I would deliver as the price. So when you think about investment banking guarantees, that becomes the question. What is this guarantee worth, given that you get to set the price? So as I said, not surprisingly, investment bankers take the price and they price the company based on users. In the case of Twitter, you might price it based on users, price it based on revenues, but it's the pricing that drives it. They'll fine tune it by calling portfolio managers to see what they get. But the bottom line is, if you look at the pricing for Twitter, and we did this last session, based on the number of users, we'd have come surprisingly close to $45 per share that the market actually paid. But let's say you come up with a price, whether it's based on revenue multiples or users. You're going to guarantee a price. You're going to want to guarantee a price lower than your estimated price. How much lower? Well, if you look at research on IPOs and you look at what happens on the opening day, when the stock opens for trading, that first day price change is going to tell you how much the offering price was set below the actual price, right? Because if on average you set the offering price at the true price, you shouldn't see any jump on average across IPOs. Across all IPOs, there's a discount of about 15 to 20%. That's how much the stock price tends to jump on the offering day. That's money left on the table, right? Money left on the table by the issuing company. But as I said, you know, it's something we'll come back and talk about. But it's also potential profits for the rest of us. So let me ask you a question. Is there a way we can try to take advantage of that mispricing by bankers? I mean, if on average the price jumps 15% the offering day, what if I set up a fund? And here's what the fund is going to do. I'm going to apply for 1,000 shares in every IPO that comes along. I want the law of large numbers working in my favor. Shouldn't that portfolio make these supernormal returns because shouldn't you get the average 15% jump? Or am I missing something here that's going to get in the way of my making profits? Yes. Well, even if I have to wait, the 15% is going to give. If that were the only issue, I'd still do it because I could wait, and I might have to wait 2 weeks or 4 weeks and 6 weeks.
Some of the times the price will then drop a little bit.
Yeah, but on average, I'm still up 15. These studies look at all IPOs. So some drop, but there are relatively few. On average, I'm still up 15%. But hang in there with me. I apply for 1,000 shares in every IPO. Will I get 1,000 shares? I mean, I've applied for the 1,000 shares, but will I get 1,000 shares in every IPO, even if it's a fair process? Why not? In other words, if I'm offering 1 million shares and there are 10 million applications that come in, I will give you only 1 in 10 shares. So even in a completely fair process, in the most underpriced IPOs, I will get only 100 shares out of 1,000. In the less underpriced, I'll get 800 shares. And in the overpriced IPOs, guess what I get? 1,000 shares, and the banker's calling me saying, would you like some more shares? Don't say yes. Because the very fact that you got 1,000 shares is really bad news. But you see what's going to happen, right? The portfolio you create now is going to be overweighted in overpriced IPOs and underweighted in the most under. This is why in practice, it's almost impossible to make money on this mispricing. So anybody who tells you there's sure profit in an IPO, just buy at the offering price first, they're missing the point of how you buy at an offering price. And second, they're not recognizing that if you try to do this on every IPO, the process breaks down. And as in this question we've kind of addressed already, you can see why companies go along with this mispricing. If you were selling 100% of your company on the offering day, no company would accept this mispricing. Think of how much money you're leaving on the table with this mispricing. You're a $100 billion company, which Facebook was. If I underprice you by 15%, that's $15 billion in the pockets of the people who got the shares at the offering price. It's only because most companies offer 5, 10, 15% of the offering day that they're okay with it, because they hope that the payoff will be in momentum and what the price will do in the following days. Go ahead, Nick.
I have a question. It's interesting, like the perception you said, because mathematically, that's exactly what's going to happen, right? You're going to end up just being overweight on these stocks because you're going to get a lot of their stock. But essentially, wouldn't that be balanced by the stocks that you get a little bit, but they get more than 15%?
Yeah, but definitely the average is not, because the 15% is based on what? That I get an equal percentage of every shares, right? That's what these studies do. They don't, so you're going to get below 15%. The question is how much below? And I think either it's 10 or it's clearly going to be below 15. The question is it 0%, right? Yeah. And that's where you're going to end up, because these studies are all premised on you can buy 1,000 shares in every IPO, and that turns out not to be true. They're equally weighted portfolios, and your portfolio is not going to be equally weighted. Yeah. Now, of course, this IPO model that I just described, the model I described, company goes to a banker sets a price, you go through the offering price, and then on the opening day, there's an auction, the price is set higher. About 18 years ago, when Google went public, they already looked at this process and said, this is such a waste of our money. You know what Google did, right? It was the first company that decided to break the traditional IPO model. They actually had an auction. They said, look, we're not going to set an offering price. That's silly. There's going to be demand and supply that sets price. So Google actually preempted the process, but not many companies followed. But in the last 5 years, there's been a lot of questions about the banker-led IPO process. People are pushing back. They're saying, because remember, the bankers, in addition to underpricing your offering, also collect 5, 6, 7% of your proceeds for services rendered. So I have a question. What are the services you get from a banker if you're a company going public that you're paying the 6, 7, or 8% for? Think like a banker. Tell me what services you offer me if I'm going public that I need you. One is marketing, right? You know the right institutional investors. You will be able to contact them, get a much bigger market view. Okay. What else? pricing. You do the pricing. So you're saying, I'm a pricing expert. I'll go along with your pricing. What else? One is I've given you the guarantee, but the fact that you don't state the price when you give the guarantee kind of dilutes it, but there is that. The first is if you're a no-name company and I'm Goldman Sachs, I've attached my name to you and now you're already more credible. 20 years ago, that seemed like a slam dunk. Increasingly though, the question people are asking is, am I getting any services? Let's go item by item, pricing. I can misprice a stock by 30%. I don't need a banker to do it. They seem to do it consistently. What's the big pricing that I'm getting? Okay. Marketing, you set the price low enough. A dog could market the stock, right? Bark, bark, buy shares, we're done, right? The credibility effect. 20 years ago, if you were Goldman Sachs, you're viewed as up there. But when Facebook went public, what the heck does Facebook need Goldman Sachs for? More people probably recognize the name Facebook than recognize the word Goldman Sachs. Many of the higher profile IPOs, I don't need an investment bank to put this, I'm not sure whether it brings down my credibility or increases to have a good investment bank attached to me. Increasingly, the services that banks claim to offer, people are looking at saying, that doesn't seem like we're getting much. So about 5 years ago, people started to get vocal about it. Bill Gurley, that I talked about, I talked about in the context of Uber for the last 5 years, has argued that maybe companies should try direct listings instead of the traditional IPO. What's a direct listing? You skip the entire offering price process. You do what Google did. You go to the market. You say, we're going to go public on October 23rd. And you let the market, demand and supply, set the price. What do you say? You don't have to pay 6% to anybody. You don't leave 20% on the table. But there's one catch with direct listings that's meant that it's relatively few companies have used it. With direct listings, at least the way the SEC has written the rules, if you make a direct listing, you're not allowed to keep the offering proceeds in the company. They've got to be cashed out by existing owners. There are ways around it, right? You go public, you pay it out, but then you make a secondary offering, because once you're public, you're allowed to raise more shares, but it's a little tedious. So direct listings have been offered as an alternative. They haven't taken off. And in the last 3 years, there's a third way in which people have tried to invest in IPOs. What am I talking about? SPACs. What does a SPAC do? A SPAC is like essentially a fund that raises money first and then goes looking for a company to go buy. So in a sense, you've outsourced. You're an investor. You say, I don't know much about pricing tech companies. I'm going to pick somebody who's an expert in this area. And the SPAC area is full of grifters who claim to be experts. You heard of Chamath Palihapitiya? This guy's like 50 SPACs. You have 50 SPACs. Grifter is what comes to mind first, and everything else follows. He might be a very successful grifter, but maybe he's successful because he's such a good grifter. What you've effectively done is you've put your money with the expert and say, you go find the stock, you negotiate the price, and in return, what does the promoter of the SPAC get? They get to keep 20% of the funds. There is no way, no place in investing where you can leave 20% on the table and actually earn excess returns over time. Now, I'm willing to state that categorically. This game is too tightly squeezed for you. So SPACs have come out in the last 3 years, and they've, of course, soared in the first two, and now they've crashed for obvious reasons. We're in a process of trying to find a better way of doing IPOs. I'll predict that we're going to end up with this hybrid. There are some low-profile companies where the traditional banking model is still going to work, where they need the bank to kind of provide them credibility and marketing. There are some high-profile companies that are going to find a way to do direct listing, and sooner or later, the SEC is going to relax the rules to allow you to keep the cash. And there are some companies where a restructured SPAC system might actually work, where instead of leaving 20% of the promoter, you might leave 5%. Bill Ackman tried to redo his SPAC, so he kept only 6% of the 20%. And if you're an investor, you say, look, I'd like to invest like Bill Ackman, you might say, look, that SPAC works for me. I think we're going to end up with different ways of doing IPOs. The assumption you always have to find a banker and the banker is going to help you, I think is kind of done. but I think it's going to take a while to get out of that. So if you're going to go work for an investment bank in the IPO area, this is not great news. Your business model just got narrower, but that's fine. I mean, you can still make a living, but it's not going to be as easy as it used to be, where every company going public went through you. Any questions on IPOs, valuing IPOs, the IPO process? Let's talk about one final scenario with private company valuation. Let's say you start a business. You're the owner of the business, it's a small business. All of the capital from the business comes from you. You're completely undiversified. Why? You just graduated 2 years ago. You've taken every dollar of your savings. And by your savings, I'm also including your parents' savings, your friends' savings, your brother's savings. You managed to get them all, perhaps legally, perhaps illegally, but it's all your savings, completely undiversified. So you can see how, when you think about risk, what risk you're going to see. So right now, when I ask you how much risk is there in the company, you're going to look at total risk. So let's say for the next 2 years, and you're making predictions for the future, you say for the next 2 years, I think I'm the only person who can provide capital. I can't approach a VC yet. When I ask you what your cost of equity is going to be for the next 2 years, you're going to take the fact that you're completely undiversified. You're going to use a correlation that reflects that complete lack of diversification. And you're going to come up with a total beta, which is sky high. Why? Because you're completely exposed to all of the risk in the company. That's for the first 2 years. You're doing this all right now, but you're saying, but 2 years from now, I think I'm going to be big enough to approach a venture capitalist. Now, what does a venture capitalist have that you don't? Now, venture capitalists might still be specialized. They might be investing in companies just like yours, but they're investing in 20 companies just like yours. So you know what's going to happen. If I have 20 companies, my correlation to the market is going to go up, not to 1, which would be a perfectly diversified, but higher than it was for an individual owner. Let's say that 2 years from now, the venture capitalist you'll approach will have a correlation of 0.5, higher than yours. That higher correlation leads to a lower total. You're still exposed to company-specific risk, but less so. Gives you a lower total beta and a lower cost of equity. You're a great planner. You don't stop there. You say, but 5 years from now, I'm going to be big enough to go public. What does that mean? 5 years from now, when you go to the market, the investors investing in your company are going to be diversified investors, and your beta goes back to being a market beta. Now, we've talked about why costs of equity change over time for companies, usually because the risk profile changes. Here, it's the same business. The only reason the cost of equity is changing is because of the type of investor investing in the company through the life of the company. Here's how it's going to play out in valuation. If you ask me to value this company for you, I'm going to estimate the cash flows. So let's say I do that, negative or positive. And then I'm going to discount the cash flows at different rates. For the first 2 years, I'm going to use a cost of equity of 24%. Why? Because it's owner capital. You have a total beta of 4. In the next 2 years, my cost of equity drops because it's venture capitalists now with the marginal investors. And when I get, or the next 3 years, and when I get to my terminal year, when I take the company public, I go to a cost of equity for a public company. So the cost of equity for a public company gives me my terminal value. My cost of equities for the next 5 years reflect the reality that for the next 5 years, I'm more exposed to company-specific risk. When I discount the terminal value, though, remember that I've got to discount back at this cumulated cost of equity. We talked about how when your cost of equity changes, you've got to be careful how you do the discounting. But the value that I get for the firm, if I do the correct thing here, adjusting the cost of equity, is 1.5 million. You're saying, what would happen if I was a sloppy? If I use the 24% cost of equity as my discount rate forever, which I've seen people use on young companies, even if they have the potential to raise VC money in the future and go public, I'll undervalue the company. Why? Because I'm not factoring in the changes that are going to come to the company based on my own projections. Conversely, if I go lazy in the other direction and say, look, this total beta stuff is too much work, I'll just use a 9% cost of equity, I'm going to significantly overvalue the company. Do things right. If you have a company where you have an expected sequencing of capital, you go from owner capital to VC to public, adjust the cost of equity accordingly to value the company. So let me state a couple of propositions about, private to public transitions, and you can tell me whether you agree. Yeah? So when I value a private company, I'm not factoring in not just the ownership structure now, but what I expect to happen to the company in the future, right? If I can go to the market and get a public company valuation, that yields a much higher value for the company. So I'll make a statement and you can tell me whether you agree with this. Private companies in sectors that are hot, where companies are going public, will be worth more than private companies in sectors where it's difficult to go public. In other words, you start a young software company. Your value for the company will be much higher than your friend who starts a restaurant, even though you might have the same potential and the same cash flows. The fact that you can go public increases your value as a company through the terminal value. Second, even in the US, IPOs boom and bust. There are years in which there are lots of IPOs, years where IPOs drop off. And often private company owners ask, why should I care? It's a public market. I'm not going public. But if IPOs dry up, every company is affected, not just public companies, because it goes around the pipeline and affects private businesses, which now don't have the escape hatch that they did before. And my third statement relates to young companies across different markets. If you own a young company in an emerging market where going public is really difficult to do, I would attach a lower value to your company than if that same company was set up in Silicon Valley, where there's a much easier path to going public. There's a reason some of the best tech companies end up in the US, because that escape hatch of going public is still far easier to find in the US than pretty much any other market in the world. The second proposition I would have, and this is a pretty straightforward one, if you run a private business where going public earlier is better, is more possible, I'm going to attach a higher value to you. So if you're, right now, if you're an AI company or a cloud computing company, you can go public with almost nothing, right? Business model. So holding all its costs, all you need to do is start the business and attach a $100 million value. If you're in a business where it's going to take work, you've got to show a business model that works. The value of private companies is going to get lower. One final point, I've made this divide between private and public companies. And until about 30 years ago, that divide was a black and white line. You were either a private company or a public company. Private companies got their capital from venture capitalists. Public companies got their money from institutional investors, individual investors. That line is getting a little blurred now. And the reason is simple. There's a gray market that's opened up in the middle. We have private companies that access public market investors. I'll give you an example. Take Uber, right? By 2014, Uber could have gone public, but they chose not to. You know why? Because they were able to raise capital from Fidelity and the Saudi investment fund, public market investors, at close to public market prices. Why would you want to go public and face the disclosure requirements, the corporate governance pressures, when you can stay private? Private companies are staying private for longer than they used to, because you can now access capital at much better terms than you used to, because you're no longer just dependent on venture capitalists for your money. So here are my final thoughts on private company valuation. If you're ever asked to value a private company for a transaction, before you put numbers down, you need to do your homework. You've got to figure out who the potential buyer is, because it affects your liquidity discount. You can't just attach a value and say, just use it, because it depends on the potential buyer. If you're asked to value a private company for tax purposes, run as fast as you can. But if this is your job, you can't run. Remember, this has nothing to do with getting the right value now. You have a very simple mission, which is come up with a number that minimizes taxes. And one final proposition, when you value private companies, that what you're essentially doing is that the owner of a private business has an option of taking that wealth and investing it in a mutual fund. That's what a total beta does, right? It says, look, if you take this capital, invest in a mutual fund, this is what you, so we're bringing that into the game with the total beta and saying, you have to be realistic. And sometimes private company owners leave value on the table because they choose to stay private. They choose to stay, and that's perfectly okay. If you get emotional dividends from running your business, I'm completely okay, but you've got to be honest with yourself about why you're running the private business. So that's the last slide for your quiz. So I'm going to start on the third packet. And even if you don't have it, don't worry, it's not a big deal. I'm going to just give you lay the foundations for what we're going to do. So let's talk about real options. As I said at the start of this class, there's very little in valuation that's new and different. This happens to be the one area of valuation where you do see new and different things. So when we talk about real options, I'm going to tell you up front that I'm going to come at this with the perspective of a skeptic. The reason is real options have become a buzzword. People use it to justify paying a premium. You do an acquisition, you pay a big premium. I ask you why, you say optionality. Sounds so good. Who's going to argue against it? When you take a bad project, negative net present value. So why did you do it? Optionality. So I'm starting to hear that real optionality the same way I heard strategic or China or all those weapons of mass distraction. So I'm going to lay the foundations for thinking about real options and why people are so attracted to real options. I call this the search for the elusive premium. You know what I mean by that? You're paying a premium over an intrinsic value. You got to justify it. Real options have become a very convenient way to justify it. But here's the basis for the real options argument. It is true that when you do traditional discounted cash flow valuation, you're doing a static valuation. You know what I mean by that? You take the price today, the cash flows today, you come up with the value today. What real options bring in is the potential that something that looks bad today could become good in the future. So one of the options we're going to talk about is the option to delay. You have a project that has a negative net present value today. What's the rule in corporate finance? Don't take the project, right? But what if I gave you exclusive rights to this project for the next 10 years? You're saying, why do I want that? I don't want exclusive rights to non-viable technology, don't you? Because something good could happen, right? The technology could shift, the market could get bigger. We're going to talk about why you might pay for a non-viable technology or a negative net present value project if you get exclusive rights to it. We're going to talk about the fact that when you value a company, you often value it based on an expected production schedule. What you're not factoring in is companies adjust their production schedules based on whether the price is high or the price is low. There's an optionality if you can adjust production schedules. When you look at a company investing in a market like China, and the investment looks like a bad investment, your first reaction is, that's bad news. Why are you doing that? Well, one excuse might be, if the investment finds a way to make money, think of how big this potential market is. It's the option to expand, the option to delay, the option to expand. And there's one final option. There are times when you make an investment. It's a long-term investment. It's a big investment, but about 3 years in, you realize it's not working out. Now, if I did this on a spreadsheet, what am I stuck with? Another 22 years of negative cash flows, right? But what if you have the right to walk away from this? You might have to give up something. That's the option to abandon. What we're going to do over the next 3 sessions is talk about putting numbers on those options. And once you put the numbers, you might come up with a number large enough that you're actually willing to take projects with negative net present values, pay a premium. And that's at the core of the real options argument. So I'm going to use a very simplistic example to introduce the notion of where the value for a real option comes from. So this is a decision tree. It's a very simple decision tree. There's a 50% chance that you make 100 million and a 50% chance that you will lose 120 million. So if I stop and ask you what's the expected value of this decision, your answer is going to be minus 10 million, right? Now I'm going to do a little sleight of hand, a little bit of magic. Here's what I'm going to do. I'm going to take this investment and make it into 2 sub-investments. The first one, you get to invest today and you make either plus 20 million or minus 20 million. If you get minus 20 million, you stop because it's an indication the investment is not a good one. If you get plus 20 million, you invest another, you continue and you make an 80 million upside with the 2/3 probability and minus 100 million with a 1/3 probability. I know it looks convoluted, but if you look at the upside, 20 plus 80, I get 100, downside is 120. If you take so it's very similar to the previous investment. There's 50% chance of winning, 50% chance of losing, plus 100 minus 120. But here's the magic. If you take the expected value of this decision tree or set of decision trees, your expected value turns positive. So my question is, what's happening in this investment that's making an investment that looked bad become a good investment? What's different about this second decision tree?
Can I take a guess?
Go ahead.
Probability of success and failure are are better for the upside.
But if you look at the cumulative probability of success, 3/4 times 2/3 half, so basically, if you look at the total chance of success and failure, I end up with roughly the same probabilities. But what do I get as in the first step? I get a signal, right? I do a small bet. It's like a test market. If the market is good, then I continue and make the second investment. If the market is bad, I just stop. I'll give you the two key components here that's driving the value, the additional value. One is learning. You're learning by observing the first experiment. And second is you're adapting your behavior based on what you've learned. Learning and adaptive behavior are at the core of the real options argument. I'll give you a very simplistic example of real options. You can see how this plays out. Let's say you have to value an oil company. You do it with a traditional discounted cash flow valuation. In a traditional discounted cash flow valuation, you estimate the number of barrels of oil the company is going to produce. You multiply by an expected oil price, you come up with expected revenues. Let's say you're completely unbiased. You make your best estimates. I think you're going to undervalue the company, and here's why. That expected production you estimated, the expected price you estimate. But remember, what do oil companies get to observe before they actually set production schedules? They get to observe the oil price. And if the oil price is high, they produce a lot of oil. If the oil price is low, they produce less. So your expected production might be right, but what you're missing is the high production happens when oil prices are high, and the low production happens when the oil prices are low. You're going to underestimate the value of the company because you're not building in the optionality. There's learning from looking at the oil price and adaptive behavior because your production is based on the oil price. You're going to see that play out over and over again with real options, is the learning and the adaptive behavior. Question, Nick?
Yeah, I was just going to say that it's kind of like whoever takes like perhaps it's kind of like a game theory kind of thing, right? You're just like bringing up a
But game theory, if you don't learn, if you don't adapt your behavior, the learning by itself is not valuable. It's learning plus adaptive behavior. So you've got to show me that your behavior will be different based on what you've learned for it to pay off as higher value. Okay? So it's a very specific sub-aspect of game theory where what you're learning on the first game actually changes your behavior in the second game in ways that make you a better player. There's a sequential game where you're learning at each sequence. Okay? So I'm going to lay out 3 broad questions that you should think about asking, because as I said, you're going to see this real options argument used on you. They'll use it to bludgeon you. So the next time somebody says there's optionality, I want you to go through these 3 questions. First is make sure there is actually an option. I'm going to draw a contrast between what I call opportunities and what I call options. And I'll give you a very simple way of differentiating between the two. Second, I want you to ask the question, does that option have significant economic value? Because if it doesn't, why are you wasting your time talking about options if it's adding 1% to the value? So we'll talk about what is it that makes some options more valuable than others. And third, not all options can be valued with an option pricing model. So when can I value this option with an option pricing model? So I'll give you what I see in terms of statistics. For every 100 times somebody uses the real options argument, maybe 20 out of the 100, there's actually an option. The remaining 80 were opportunities. They were just using the wrong word. Among the 20 where there are options, maybe 5 have significant economic value. And among the 5 that have significant economic value, maybe a couple I can actually put a number on it with an option pricing model. So let's start on the first question. How will I know whether there's an option, when there's an option in a decision? To answer this question, let's go back to option basics. Let's think about what is it that makes an option an option. The first, with an option, you get the right, keyword is right, not an obligation to buy or sell something at a fixed price. The right to buy something at a fixed price is called a call option. The right to sell something at a fixed price is a put option. It's a right. Second, options by their very nature are derivative securities. They're leeches. For them to have value, there's got to be an underlying asset. So if you use a real options argument on me, I'm going to ask you a very simple question. What's the underlying asset here? And if you can't answer, the conversation is done. So the second feature of options is there is an underlying asset. And third, there's a contingency, something that determines what the payoff is going to be. With a listed option, it's easy, right? The underlying asset is the stock on which the option is traded. The strike price is compared to the stock price. It's a call option. I pay you the difference. But that's basically what you're looking for. the easiest way to spot when you have an option is to draw a payoff diagram. If you've taken a foundations class or in a corporate finance class, you've probably seen a payoff diagram for an option. Here's what it looks like. If you have a call option, you have limited losses and potentially unlimited profits if the stock price goes up. If you have a put option, you have limited losses and not quite unlimited because the price can't go below zero, but very large profits if the stock price goes down. Remember that limited losses, because it's going to come back and become part of why options are so different from every other asset. The losses are limited. The profits are potentially very large or unlimited. So here's what you're going to see me do with every real option that I'm going to describe. I'm going to draw the payoff diagram for something and say, hey, look, that looks like an option. I need to use an option pricing argument. So one of the first things to do if somebody uses an options argument is draw the payoff diagram for whatever they're describing and see if in fact it looks like an option. Second step, when does that option have significant economic value? I'm going to throw a word that you're welcome to use on the next person trying to use the options argument. It's exclusivity. For an option to have value, you and only you should be able to exercise that option. I'll give you an example. About 10 years ago, an MBA walks into my office, second year MBA graduating, and he said, I'm very excited. My landlord, he'd been renting his apartment. He said, my landlord has given me the option to buy my apartment. Now I want to use a Black-Scholes model to value it. I said, isn't that a little bit of an overreach here? He said, no, I've spent a lot of money in the MBA. I want to use a Black-Scholes model. So I said, okay, your landlord said he was giving you the option to buy your apartment. What price did he mention? The MBA thinks for a moment. He says, you know what? He really didn't mention a price. I said, let me get this straight. Your landlord has given you the option to buy your apartment at the prevailing market price. Is that what this option is? He said, I guess it is. And I said, what do you think that option is worth? Everybody can walk in and buy at the prevailing market price. There is no option here. Exclusivity. But let me make it specific to projects. One of the things we're going to talk about is companies investing in big markets, even though they're losing money, on the hope or the expectation that somewhere along the way they can expand. I'll make this specific. Let's assume Marriott opens 10 hotels in China. And let's say it does it with open eyes, expecting to lose money. The net present value of that investment is negative. You're saying, why would they do it? Well, if things work out and they're doing better than expected in these hotels, here's what they plan to do. They plan to open 500 more hotels in China. It's a huge market. It's a great upside, right? That's the argument they use. What's the weakness in that argument? What's the weakest link? Yeah. In other words, they open the 10 hotels, they do their research. Who's watching the hotels? The Hilton guy has a spy out there. You've got 5 other hotel guys just watching the hotel. They watch how well you're doing, and because you're doing well, just as you get ready to open your 500 hotels, Hilton beats you to the punch. They make you do the homework and the market testing. There's no exclusivity. You know what make this an option? If the Chinese government said, if you come in and open 10 hotels in China, we will give you the exclusive right to open more hotels in a particular part of China. That's an option. That's what you're looking for. Look for the exclusivity. And once you've decided that there is an option embedded in here, and there is value, we know what drives the value of an option. In fact, there are only 6 variables that determine the value of an option. Options are very easy to structure because they're connected to the underlying asset. 3 relate to the underlying asset. As the value of the underlying asset goes up and down, options are obviously going to go up and down with them as well. So if I have a call option, the value of the underlying asset goes up, call options all become more valuable, put options all become less valuable. So the value is the first factor. The second, and this is where I think options deviate from the script. As the uncertainty about the value of the underlying asset increases, the options become more valuable, both call and put options. This is weird. As risk goes up, options become more valuable. But why is that again? What's the intuition about why options, with options, risk is your ally?
Your downside is fixed.
In other words, most you can lose is already said. To you, risk is all upside. So the greater the variability of the underlying asset, the more valuable options become. Third, this is kind of tricky. When you have an option on an asset that pays a dividend in whatever form, call options become less valuable and put options become more valuable. Think about it. Let's say you buy an option on a stock that pays a $1 dividend every 3 months. On the ex-dividend day, roughly speaking, what will happen to that company's stock price on the day of the dividend? It's going to drop by roughly $1. And you as an option holder have to factor that in. So call options become less valuable, put options become more valuable when you have expected dividends. There are two variables related to the option. The strike price of the option obviously matters. With a call option, I give you the right to buy something. You'd rather have the right to buy something at a low price than a high price. So as strike prices go down, call options become more valuable. Put options become less valuable. And the longer I let you play the game, the more valuable the option is. The right to buy something over the next 5 years is worth more than the right to buy the same thing over the next 6 months. There's only one macro variable that shows up in option pricing. It's the level of interest rates. And here's why it matters. What do you get with the call option? The right to buy something at a fixed price 3 years from now, right? When interest rates go up, the present value of what you have to pay becomes lower. So call options become more valuable as interest rates go up, and put options get less valuable because you receive that amount 3 years from now. As interest rates go up, the present value effect kicks in. So we know what drives the value of an option. And of course, over the last 50 years, we now have option pricing models. Option pricing models are mathematically messy, but I'm going to give you the intuition behind modern option pricing. Until 1971, the way people priced options was by doing what they did with every other asset. Take the expected value, adjust for the discount rate for risk. But in 1971, Fisher, Black, and Marr and Scholes at the University of Chicago said there's a way around this. They built their argument around two basic principles. The first is they said, we can create something that looks just like the option by combining the underlying asset, neither borrowing or lending. It sounds mysterious, but there's a way in which you can create something that looks exactly like the option in terms of delivering cash flows by combining it's called a synthetic option. It looks like the option, it acts like the option, it delivers the same cash flows. It's called a replicating portfolio. So first part of every option pricing model is to come up with that replicating portfolio. And second, Black and Scholes said, if the replicating portfolio and the option deliver the same cash flows, they have to trade at the same price. It's called an arbitrage argument because they trade at different prices. It's a sure profit. Replication and arbitrage underlie every single option pricing model. So next class, when we start, one of the things I'm going to take you through is how do you come up with that replicating portfolio? Because if you can do that, you've solved the option pricing puzzle. I'm going to use what's called a binomial model first to illustrate the replicating portfolio and how you come up with it. And then I'm going to transition to the Black-Scholes model because you often plug and chug into that model, but embedded in that model are replication and arbitrage, just as the binomial model. But remember, Monday, your first 30 minutes, we start with a quiz, and then we will continue with real options. So make sure you hang around after the quiz.
Yeah, dude, I've been here for like 2 days.